Faithfully delivering value, interpreting the world's best books. Hello, this is Sally's Book Talk. Today we're interpreting the next part of the Federal Reserve story. In the previous episode, we discussed how during America's first century, massive financial imbalance existed between eastern and western regions. The East had major banks and abundant gold reserves, with a formal and developed financial industry. The West lacked gold reserves, relying instead on alternative currencies like government-restricted silver, abolished greenbacks, and even locally issued rural credit cooperative money. When the U.S. adopted the gold standard in the late 19th century, it triggered severe financial crises in the West, intensifying regional conflicts and birthing a new philosophy. Currency should be based on actual economic growth, IGKO, not bank gold reserves. In 1914, through negotiations between elected officials and Eastern bankers, the Federal Reserve emerged to mediate these tensions. But with the gold standard still in place, Eastern bankers controlled the Fed for its first decade plus. Only in 1935, driven by President Roosevelt and Fed Chair Eccles, did banking reforms abolish the gold standard and tether currency to real economic growth. Yet these reforms made the Fed overly political and cost it independence. In this episode, we'll explore our third question. Why did the post-war Fed permit excessive dollar printing? First, post-1935 reforms led Eccles to acknowledge Treasury dominance in economic policy. This mindset enabled massive government borrowing, especially during World War II when spending relied more on debt than taxes. When Roosevelt entered office in 1933, U.S. debt was $22 billion. After Pearl Harbor in 1941, it hit $48 billion. By World War II's end in 1945, debt skyrocketed to $280 billion, a situation deeply troubling Eccles. He particularly objected to commercial banks acting as mandatory intermediaries in Treasury markets. Transaction fees meant much Fed printed money became bank profits instead of entering the real economy. Eccles wanted to change this. He first tried pushing legislation to restrict secondary trading and marketization of Treasury bonds, but failed. The remaining solution was to reduce the total Treasury debt, thereby lowering the financial costs of the national economy. After WHO, Eccles proposed quickly reducing Treasury issuance, ending government deficits, and paying down debt. This triggered fierce clashes with the Treasury, since reducing debt would require spending cuts or tax hikes. The Treasury considered both options unworkable, creating a stalemate. In 1948, President Truman refused to reappoint Eccles as federal chair, ending an era. Despite soaring U.S. deficits during WA2, no severe consequences occurred. This was because the war sparked an industrial revolution, where economic growth matched money supply expansion. During America's 5 war years, productivity grew by 75%. From 1942 to 1944, U.S. GDP grew annually by 16%, 15%, and 15%, respectively. To meet war needs, the U.S. massively borrowed, developing new government-funded industries like electronics, oil, aircraft, shipbuilding, steel, and nuclear energy. These emerging industries cemented U.S. global dominance, but post-war growth slowed. In later decades, growth rarely exceeded 5%, exposing the Fed's lack of independence. Monetary policy is easier to loosen than to tighten. Post-war inflation arrived as expected, reaching 14.4% in 1947. Though no longer federal chair after 1948, Eccles remained a board member. He negotiated with the Treasury alongside other board members. The U.S. government finally recognized the dangers of excessive inflation. In 1951, the Treasury and Fed reached an agreement granting the Fed independence in setting interest rates. The Treasury could no longer require the Fed to buy treasuries below market rates, as during 2114. Months after the agreement, Eccles resigned from the Fed board, returning to his Western roots and fading from politics. Some historians argue the 1951 agreement granted the Fed full independence, while others remain skeptical. Because afterward, America rapidly entered the Cold War with the Soviet Union. To fund the arms race, it maintained massive deficits, trapping the Fed in politics. Unable to force debt repayment or reduce money supply, it focused on market interest rates through open market operations. Thus, dollar issuance ballooned like a snowball alongside growing U.S. debt. Yet U.S. inflation remained low throughout the 1950s to 60s. This resulted from the Bretton Woods system established post-WWE, the dollar pegged to gold, other currencies to the dollar, making it the global reserve currency. European dollar demand surged suddenly. Excess dollars flowed into Europe, forming the euro-dollar market, preventing U.S. inflation. Ironically, excessively low inflation became an economic problem. From 1950 to 1960, U.S. Treasury rates rose from 2.3% to 4%, while inflation hovered around 1%. Excessively low inflation meant sluggish profit growth for consumer businesses. Foreign governments and institutions holding dollars often earned more from U.S. treasuries than many American businesses. And voters deeply resented this situation. In 1960, they elected reform-minded young politician Kennedy as president. After taking office, Kennedy implemented Keynesian stimulus, massive infrastructure investment, new public schools and hospitals, and enhanced welfare. After Kennedy's 1963 assassination, successor Johnson continued his policies. From February 1961 to December 1969, the U.S. economy grew continuously for 106 months, an unprecedented achievement. Essentially, Kennedy's reforms competed with other Bretton Woods nations for excess dollars through fiscal expansion. Though U.S. economic data appeared stellar, it drove steadily rising domestic inflation. During this period, William Martin served as chairman of the Federal Reserve. He came from a banking dynasty. His father, William Martin Sr., was one of the Fed's founders. In 1913, when President Wilson negotiated with Wall Street to establish the Fed, Martin Sr. represented the administration. Though a financial dynasty, the Martins operated primarily not in New York, but in Missouri, America's heartland. Thus, Martin understood Western banking's historical struggles and supported Eccles's philosophy: monetary policy should serve real economic growth. He famously said, "The Fed should take away the punch bowl just as the party gets going," meaning when money supply growth outpaces real economic needs, the Fed must break promptly to prevent financial bubbles harming the economy. Yet despite this philosophy, he faced formidable political obstacles in practice. In 1965, most Federal Reserve members believed rate hikes were needed to control inflation. But after just one small increase, Johnson summoned Martin to his ranch and berated him. The White House interfered relentlessly, even reshaping the board through reappointments. Though Martin fiercely defended Fed independence, he fought alone. Gradually, his resolve weakened. By 1968, U.S. inflation neared 50%. After months debating aggressive rate hikes, government threats and pressure led Martin to maintain loose policies. In 1970, hardliner Nixon became president, immediately replacing Martin with his advisor Burns. Burns obediently loosened policy as requested, forfeiting the Fed's last chance to curb runaway inflation. Many actually understood early that Bretton Woods was unsustainable. Economist Robert Triffin proposed the famous Triffin dilemma. The dollar's global role required ever-growing supply via rising U.S. debt, but excessive debt would erode confidence, undermining its reserve status. There was only one possible outcome: the collapse of U.S. national credit. Simultaneously, the dollar could no longer serve as the world currency. In the 1970s, this prediction nearly became reality. Then emerged America's savior, Paul Volcker. To summarize our third issue, from 1951 to 1970s, the U.S. economy faced conflicting demands: White House political needs versus dollar credibility and price stability. The Fed prioritized the former. Under Bretton Woods and Kennedy's stimulus, excessive dollar printing post-2014 critically threatened U.S. sovereign credit. Finally, our fourth question: how did Paul Volcker save the U.S. economy and its credit? Volcker shared key similarities with the Fed's previous hero, Eccles. Neither had formal finance training. Volcker graduated from Princeton's School of Public Policy. As a freshman, he didn't even take economics. His passion was government administration. When he graduated in 1949, Fed government relations were academia's hot topic. He wrote his thesis on this from a public administration perspective. Catching the New York Fed's eye, they invited him to intern. After earning a political economy doctorate at Harvard, he naturally joined the New York Fed. In 1962, he moved to the U.S. Treasury. During Volcker's NY Fed tenure, monetarism emerged as a major economic school. Milton Friedman, later a Nobel laureate, led this movement. He criticized the Fed's post-war focus on controlling interest rates. Instead, he advocated pre-War II-style money supply targeting. But as noted earlier, massive dollar outflows to Europe made total control impossible. Friedman argued the Fed should focus solely on domestic money supply. Whether its policies caused foreign financial crises was secondary for America. Though monetarism wasn't mainstream initially, the Fed and U.S. government objectively had to abandon responsibility for foreign markets. During the 1960s, while fighting the Cold War with the Soviet Union, America also entered the Vietnam War, causing military spending and foreign debt to balloon. Under Bretton Woods, the U.S. was required to exchange dollars for gold at $35 per ounce for foreign governments. By 1971, U.S. gold reserves at that rate totaled $18 billion. But overseas dollars quadrupled that amount. Everyone knew the U.S. couldn't sustain it. Foreign governments rushed to exchange dollars for gold. Just meeting existing demands would require $36 billion in gold, double the actual reserves. Clearly, America could no longer fulfill its international commitments. On August 15, 1971, Nixon announced suspending dollar-gold convertibility. Subsequent U.S. negotiations with Europe and Japan led to Bretton Woods' orderly dissolution. Notably, Paul Volcker, then Undersecretary of the Treasury, led U.S. negotiations. Through masterful negotiation, he persuaded governments to accept a controlled, sharp devaluation of the dollar. This caused massive losses for dollar-holding governments, but averted total monetary collapse and shed U.S. international obligations. Post-crisis, monetarist theory dictated Fed focus on domestic money supply, but Burns, Nixon's Fed chair, ignored this as elections neared. Nixon barred tightening policy during his re-election campaign. In 1972, bankers widely predicted rising inflation. 12 regional Fed banks submitted 22 discount rate hike requests urging anti-inflation tightening, all denied. Nixon secured re-election. But U.S. inflation then spiraled uncontrollably. Daunting, inheriting crisis. Democrat Carter became president, inheriting a Republican mess. Soaring prices and recession. Classic stagflation. Carter ordered the Fed to tighten monetary policy, hoping to control inflation. But it proved useless. By June 1979, inflation remained double-digit and worsening, teetering toward hyperinflation. The dollar risked becoming worthless paper, yet the Fed had already hiked rates to 10%. Economists calculated this was the absolute limit. Higher rates risked repeating the Great Depression's economic collapse. Carter couldn't find any Fed official willing to raise rates further. Stumped, advisors recommended Paul Volcker. Why did Carter appoint Volcker? Because Volcker appeared domineering and arrogant.
The Carter administration wanted rate hikes to curb inflation, but refused to take blame for recession. So they chose someone with a poor reputation as a scapegoat.
True to form, Volcker relentlessly hiked rates upon taking office. But within 6 months, Carter couldn't bear it. With the 1980 election looming, Carter sent emissaries urging Volcker to pause hikes, but Volcker remained unmoved. In 1980, he intensified monetary tightening. By election day, U.S. rates had soared to nearly 20%, a historic high. The outcome was predictable. Carter suffered a landslide defeat, the largest margin in U.S. presidential history.
Volcker's hikes lacked theoretical backing. Fed economists had concluded 10% was the maximum safe rate.
So Volcker sought new economic theories to justify his policies. He turned to monetarism in 1979. Shortly after taking office, he announced the Fed would henceforth base policy on money supply. This implied the Fed wouldn't intervene no matter how high rates climbed, as long as money supply targets were met. Such unwavering resolve electrified capital markets. Previously, persistent U.S. inflation stemmed largely from public expectation. Historical patterns showed the Fed always caved to government pressure during election years. Loosening policy. Now, Americans understood this Fed chair differed radically from predecessors. He could withstand political pressure. U.S. inflation expectations finally began to decline. So why did Volcker dare confront Carter?
Because while the president appoints the Fed chair, he can't remove him unless reelected, allowing appointment of a replacement.
Meaning Volcker likely anticipated Carter's defeat early on, demonstrating his political acumen through this confrontation. By 1981, inflation expectations had fallen, with price growth dipping to single digits, but a serious problem remained. Strong unions kept manufacturing wage growth above 10%. With most wages stubbornly high, substantial inflation reduction was nearly impossible.
Volcker took on unions directly, personally, negotiating with business owners and union leaders.
New President Reagan became his ally on this issue. By firing thousands of striking government workers, Reagan signaled unequivocally this administration sided with capital over labor. After a year, manufacturing real wages plummeted, and by late 1982, U.S. inflation finally dropped to manageable levels. In July 1982, the Fed cut rates, triggering strong recovery and launching 2 decades of stable growth.
But America's economic structure permanently changed. Traditional manufacturing wages and union power kept declining, while capital and tech-intensive industries rose.
This occurred because Fed's high rates triggered massive overseas dollar repatriation. These funds flowed into high-value emerging industries, the foundation of U.S. global dominance since the 1980s. Ironically, monetarism viewed overseas dollars as mere noise to ignore. And yet, Volcker leveraged them for economic transformation, revealing his fundamental divergence from monetarist doctrine. Indeed, orthodox monetarists like Friedman denied the Fed executed their theory. Volcker only cited money supply when raising rates. When he started cutting rates in 1982, massive overseas dollar inflows pushed money supply above targets, yet he never mentioned it. This proves monetarism held only political utility for Volcker. He was never Friedman's disciple.
Another key question: who contributed more to U.S. growth, Reagan or Volcker?
Despite Reagan's outwardly optimistic resolve, his economic policies were fundamentally chaotic. So-called Reaganomics combined supply-side economics with fiscal balance, conflicting goals. Supply-side economics centered on tax cuts, but fiscal balance amid untouchable military spending demanded tax hikes. Internal indecision within Reagan's circle was stark, with advisors often contradicting each other. Well, only Volcker consistently knew his objectives, and politics often bends to resolute leaders. Thus, America's 1980s growth owes more to Volcker. Yet Volcker's economic transformation planted dangerous seeds, notably financial sector overexpansion. Before 1979, U.S. banking assets were far smaller. Among the world's 12 largest banks, the U.S. had 3, Germany 6, Japan 5, France 4, and Britain 2. Volcker's policies attracted massive foreign capital to America.
By the 1990s, Wall Street became synonymous with global banking giants.
Finance grew so powerful it created too-big-to-fail institutions.
This remains a legacy issue from Volcker's era. Another major flaw: complete abandonment of labor-intensive industries. A strong dollar shifted these industries to developing nations. While benefiting U.S. consumers through cheaper imports, it devastated traditional manufacturing regions, causing industrial hollowing out. Nude, summarizing, legacy-defining. Summarizing our 4th issue, Volcker, appointed federal chair in 1979, saved the dollar through resolute tight money policies and guided economic transformation. He freed the Fed from political influence, establishing credibility, but simultaneously created new economic challenges. Traditional manufacturing and working-class interests were sacrificed. while finance and high value added emerging industries rapidly rose. We've now covered all the key insights of this book for you. To briefly recap, the Federal Reserve was born out of intense conflict between U.S. economic development needs and New York financial industry interests. For its first 2 decades, it remained controlled by Wall Street. From 1935 to 1951, it broke free from Wall Street control, but became overly dependent on the government. After gaining independence through negotiations with the Treasury in 1951, the Fed still struggled to shake off political influence, ultimately leading to hyperinflation. Or in 1979, after Volcker became federal chair, he helped restore the institution's credibility. The book's author believes Volcker shared the same financial philosophy as Benjamin Strong from the 1920s. We had, meaning, when Wall Street interests conflict with U.S. real economic development, the Fed might still side with Wall Street. Through the Fed's bailout actions after the 2008 financial crisis, we can see that because U.S. banks were too big to fail, the Fed had to rescue banks first, and then hope they'd help the real economy.
But in reality, more Fed bailout money flowed to the stock market than the real economy, with the Dow Jones Index quadrupling since 2008.
This bears many similarities to the book author's predictions. The book's conclusion states that capitalism has its flaws. It lacks a natural valve to control greed. Capital's inherent ambition will always seek maximum returns, with no one to signal when limits are reached. This statement perhaps applies to today's U.S. financial markets as well, recalling how, in 1928, Strong's efforts to aid European markets caused the Wall Street stock bubble, ultimately triggering the Great Depression. After 2008, the Fed's bailout sparked an even larger stock bubble, with an uncertain future.
Facing the current situation, we should value this important book, On the Fed, published in 1987, as a historical lesson.
All right, that concludes our interpretation of this book on the Fed. Listening notes are below the audio. See you tomorrow.